Hey everyone, me Kevin here. Are we in an everything bubble? And are we about to see an everything crash? And if we were about to see an everything crash, is there a way we can see the everything crash coming so we can be more prepared? On this channel, I love providing insights to you on inflection points, changes that are happening in the economy with our government, and things that relate to our money. And in this video, I'm going to teach you some new simple division you could do to keep your eyes on whether or not this big everything crash is coming, or better yet, when it's coming. Let's get started. First, folks, Robinhood gave me a special link and you gotta use it. You literally get free money and you don't even have to give them a dime. Yes, you can get free money for not giving someone a dime. Robinhood, the stock brokerage. If you have not opened an account there, use the link down below. Open an account with Robinhood. When you do and you link your bank account, you will get 1 free stock within 24 hours, and then you will get an additional 3 free stocks before February 1st. I am pretty much the only creator that I know that has this special 4 free stock link, and I highly recommend you use it before February 1st because you will get 4 free stocks from Robinhood, and you are not obligated to deposit any money. All they want you to do is link your bank account, which could be any bank account of your choosing. Anyway, let's now get into the topic of the video. But again, that link is down below, metkevin.com/Robinhood. All right, the argument of this big crash is simple. Think about this. When the pandemic hit, banks panicked and started reducing lending availability, which led to businesses having less access to cash. And before we saw widespread lending cuts, which we did start the initial signs of lending cuts, the Fed jumped in and said, no, stop cutting lending, banks, fear not, we are here. Brr, which has now become the symbol for money printing. Crank the money printer. That is, the more the Fed cranks, which is really symbolic because we're really not printing the money, it's just all digital now, but it's much more understandable to just say the money printer is cranking. Anyway, the more the money printer cranks, the more money is essentially available to banks and big businesses for banks to lend to businesses and for businesses to use to invest and hire people with and put money into research and development and come up with new products and basically try to make our society grow and our economic engine grow faster. The problem is, what do you do when the pandemic's over and now everybody's gotten used to the crankshaft turning and the money printer going over and over again? See, when the world literally injects $12 trillion of stimulus into the entire economy in just 1 year, you tend to succeed in preventing pain in the short term, but it makes you wonder, what are the ramifications of all this money printing going to be in the long term? And we're not even here to talk about taxes. That's a whole nother issue, okay? Taxes, that could be its own video. Here, we're talking about the market. And see, preventing short-term pain is what we saw for pretty much anybody who owned businesses on a larger scale, good or bad businesses that should have gone bankrupt but didn't because of all the monetary and fiscal support. We saw a lot of businesses float up. We saw company valuations skyrocket on the stock market, and we saw real estate valuations skyrocket. Basically, people who had wealth just got wealthier. And anyone who didn't have stocks, businesses, or real estate got left behind. AKA, this is why we have the K-shaped recovery. People are like, Kevin, what you just described is the shape of a K. The poor kept getting poorer, and the rich got richer. It's kind of what's been happening. So if you didn't own stocks, businesses, or real estate, you got hurt in 2020, and you felt like you missed out because you did. But the thing is, the stimulus has been working. Jobs have started to come back, consumerism has started to come back, and while there's still work to be done, which is one of the other excuses why the money printer is going to keep rolling around, we have people like Jerome Powell over at the Fed as the chairman of the Federal Reserve acknowledging, valuations are a little high, but that's not gonna stop us from cranking the money printer, which has a lot of people really pissed off. And if you're like the 1% of people who actually care about specifically what he said, here it is. He said, quote, "Admittedly, PE ratios are high, but that's maybe not as relevant in a world where we think the 10-year treasury is going to be lower than it has been historically from a return perspective." Literally, in other words, he don't care. He gonna keep printing money, okay? Valuations right now don't matter. He's just gonna keep cranking because, we need to. And this is really what's raising the fears that, if he's really gonna keep rolling the crank, then isn't it possible that we're creating an everything bubble? That is, we're propping up company valuations to insane highs, and that includes companies that have no product, no prototype sometimes even, sometimes companies that are complete frauds, not to mention any names, Nicola, sometimes just companies that really probably should not be public, but go to market in an expeditious way so they could raise money in the stock market via very popular tools like the SPAC IPO. Since July of last year, so in the midst of the pandemic, through mid-December of last year, we literally averaged more than one SPAC IPO per day. Like, everybody's going, please get me to the market so I can have my business have access to the stock market. And everybody who buys into my stock, because stock prices keep going higher and higher and higher, everything's just on a rocket ship to a moon. Now the businesses can basically sell more shares, dilute the existing shareholders, take that extra money they just raised on the stock market with nobody else getting hurt, valuations continuously going up, take that extra money and do more research and development and hire more people and build bigger factories, and the cycle just continues. And it makes you wonder, like, oh my God, can it stop? Can it be stopped? Should it stop? Well, this is where the bears come in. And what we're going to do is we're going to listen to a particular bear here for a minute. And then we're going to analyze why he says what he's saying. And once we know why he says what he's saying, we're also going to be able to understand, okay, is there a way we can get a heads up as to what his concerns are? Let's just tune in and find out. Here we go.
The S&P 500 trades less than 1% away from its most recent high. When do you think these risks that you've outlined will start to hit the market? What's the timeline?
Well, I've been a long-time bear, and I've seen bear markets approach, and people have called me a perma bear. I'm a believer in the Austrian School of Economics that says that the magnitude of the decline is proportional to the excesses created during the prior boom. I was also early back in 1998, 1999, and in 2006 and 2007. Markets tend to get extended. It's hard to say exactly when it's going to break, but when it breaks, it's likely to break hard and cause investors to suffer for a long time. People forget that back in 1929, after that crash, it took them 25 years to recover their original investment. So it doesn't necessarily have to be like it was back in March, April, where you decline and you come back and you make all-time new highs.
All right, so then the CNBC article attached to this video says, you know what? The market could crash by 30% for as long as 2 years. Or we might not ever see the new highs that we've seen. We could just turn into a Japan and see a peak now and basically never return to the levels for another 20 or 30 years. And this is partially because this individual believes in the Austrian School of Economics. And that school believes that market crashes occur when excesses come into the market, and that super low interest rates, like the 0% rates we have at the Fed and fractional reserve banking, basically lead to a massive imbalance between investments and saving. And then borrowing leads to what's known as malinvestment, which just gets reiterated by cheap debt. And this is really similar to the cycle that I started out with, because what I just described, a little bit complicated. But think about it this way. When debt is cheap and you throw money into the stock market with money that you borrowed, and then that goes up in value, even if it's a crappy company with barely any sales or products, you psychologically go, well, damn, money's so cheap to borrow, let me just borrow a little more and put that into the stock market. And then the stock keeps going up even more because more people are borrowing and putting more money in. And what really happens is we keep seeing these higher and higher highs, and we're really teaching ourselves and programming ourselves to just take on more debt and buy more stocks. Take on more debt, buy more stocks. And this could lead to the acceleration of what this individual believes would be malinvestment, because you invest in companies you probably shouldn't be investing in, but because the market is essentially manipulated with low interest rates, these companies get propped up. Companies that should be going bankrupt don't go bankrupt, instead, again, propped up. And what will eventually happen is all of these companies that should not be propped up will eventually mean revert. We will have a massive economic catastrophe of a crash when finally inflation kicks in interest rates have to go up. The first companies people jump ship out of are the companies that don't actually have real products or a real profitable business. Investors dump those stocks. The stocks plummet 90% in value. The S&P 500 drops 30% for 2 years, and we potentially never see the new highs that we are seeing now every freaking day, basically. Yeah. So, could this happen? Yeah. In fact, yesterday I told you we got to pay attention to what the Federal Reserve says about bond purchases coming up this week. But is there something else that we could pay attention to? In addition to what the Fed is doing, is there another signal that we could pay attention to? And the answer to this is yeah, there is. See, for the market to crash hardcore and for these bears to finally be able to come out of their caves and go, I was right. I knew the market would plummet. Well, for that to happen, we are going to need inflation. And so there's one big thing that's kind of making inflation not appear right now, and that is called the velocity of money. And I'm going to show you a really simple bit of division that you could do. So you can learn this and you could track this. And I promise you, if you learn this and track this, you are going to be ever grateful that you did. It is very, very important. So what we can do is first, we can pull up all of the money that exists in circulation right now. And every bit of money that's in circulation right now is considered the monetary base. This is different from like M1, M2 money supply. This is the monetary base. This is the money as it circulates through our economy, how much money is actually being used to create our GDP. Because remember, GDP is just the sum of all of the transactions that happen. Okay, well, to make transactions, you need to have money to make that with. The monetary base is the measure of how much there is, how much money we can actually use to transact with. So here we go. So this is the monetary base. And right now, there are about $5.26 trillion outstanding in the monetary base. You could see that it's basically skyrocketed during the pandemic here. It's gone to the moon. And this makes sense because there's been so much injection of money printing and fiscal stimulus, monetary stimulus, all of that. So what we can then do is we can also compare this to the GDP. So this has been our GDP. It's kind of just been up and to the right ever since, the mid-1940s from when they began this measure here. And then we could see this decline in GDP here, obviously in 2020, the crash and that little V-shaped recovery we got here. So when you really zoom out over the last 15 years, it doesn't look too impactful. But the shape of this graph isn't so much what we care about. What we care about is this number right here, $21.17 trillion. And so here's something neat that you can do. So on this, we had 21.17. Over here, we've got 5.206 trillion. Watch this. We can take 21.17, that's our GDP, divide that by all of the money that exists in circulation, that's used to come up with the GDP number, and then we get an answer of roughly 4. It's about 4. And so what that number represents is the velocity of money. The velocity of money works like this. When you spend $1 at a hot dog stand, that dollar then circulates through the economy, sometimes around 4 to 7 times. Right now, the number's at 4, because we just did the math. It's at 4. This means the dollar goes to the hot dog stand vendor. He goes and buys buns from his manufacturer. The bun person then gives that money to their employees, and then the employees pay their children's tuition, and eventually somebody puts it into the stock market or savings, and then it's not really circulating anymore. So that's the velocity of money. Right now, that stands at about 4. Well, if we go back just 1 year ago, when we were at a much lower level over here in like January of 2019 in terms of how much money was outstanding, we had about $3.13 trillion outstanding in the monetary base. Our GDP was roughly the same, 21.561. And if I divide that out, we get a velocity of money of about 6.88. In other words, if the velocity of money right now is $4, we have seen a roughly 42% decline in the velocity of money. That's huge. We have literally seen the velocity of money almost halve. That's pretty big. And it's really interesting because if we think about it, we had $3 trillion-ish of stimulus in 2020. Maybe we'll see another couple trillion here in 2021. But $3 trillion of stimulus is just about 15% of our economy. Well, to get to 42% to match this decline in velocity of money, we could literally print $8.8 trillion to match the rate at which the velocity of money has fallen and probably not see inflation. In other words, because we're circulating so much, like the money that we have, we're circulating so much less frequently right now, partially because a lot of us are stuck at home, we're not actually forcing prices up. Now, some prices are going up, like food prices are going up, but overall, at least in conventional measures of inflation, we're not really seeing the inflation yet. And that's why a lot of people are like, dude, how are we printing so much money and not seeing inflation? This is nuts. Well, this is why. Just explained it. We're not using the money that we have as much as we have previously. Like if we take our money and put it into the stock market, the velocity of money is like 1.5. It's super low. You got to spend it to get the velocity. So that's interesting. But what happens when COVID goes away and we all go back to the normal circulation or our normal ways of doing things as we did in 2019? Well, some argue, especially the bears, that that's when we're going to see the massive inflation. Because what's going to happen is, remember, before we were at like a 6.88 in terms of velocity of money, almost 7, right? If we go back to that level, well, I mean, just watch this. Let's go back to the chart here for a second, just to show how crazy this can be. Okay, well, let's do it together here. So let's go back to the chart. Let's erase some of this. The monetary base right now is $5.2 trillion. That's where we are right here, $5.2 trillion. We previously had a velocity of money of 6.88. Let's use that number, okay? 6.88. And right now the economy size is about $21 trillion. And if the economy grows at around 4% a year, that's pretty good. If it grows at 10 or 15% a year over and over again, that's probably growing way too fast. It's overheating, and there's a sign that we're probably seeing a lot of inflation to see GDP go up that high. Well, remember, right now the monetary base is 5.22. The velocity of money used to be in 2019 6.88. Right now it's 4. That's why we're not seeing inflation. But what if we went back to 6.88? Well, let's multiply these two. 5.2 that in terms of $1 trillion, the money that's available, times a velocity of money of 6.88. That would mean our economy, so our new GDP, would turn into $35.7 trillion. In other words, our GDP would increase about 65 to 70% in a matter of, however long it takes for this velocity of money gets back. So if this happened in 2 years and our economy blew up 66% in 2 years, which is that would just absolutely be nuts, we would probably have the most catastrophic, disastrous inflation we have ever seen in the history of inflation. Like, if that happened, if our GDP shot up 70% in 2 years, which would be somewhere around, an annualized rate of maybe 28%, 30%, something like that per year, that would be nuts if our GDP exploded to $35.7 trillion. Because certainly we're not becoming 70% more productive. It would just be all of the money we printed is now coming out and going, hello, America, I want to be in the market, as opposed to in someone's savings account or the stock market. That would be really, really bad. Now, do we actually think the velocity of money is going to go back to 7 that quickly? No. Personally, I've called what's coming a frugal decade. That is, by definition, I believe, and this is my definition, right? I believe the frugal decade means we are going to be much more interested in investing in real estate and stocks in 2020 to 2030 than we have ever been in history beforehand because of the lessons we learned during 2020. In other words, we will be brainwashed to go, spend less, invest more, because that's how you build your wealth. I never want to be left behind again. That, to me, has the real potential of leaving the velocity of money low, which means maybe we don't see inflation. Maybe this is just a huge adjustment to basically this new normal, and we never get back to a velocity of money of 6 to 7 ever again. Entirely possible. But, and this is not me trying to project who's right or wrong. Is it the Bears or is Kevin right? Or who cares, right? The point of this entire video is to say to you, well, first get your 4 free stocks with Robinhood because it's literally free money and there's no reason for you not to sign up for Robinhood if you have not yet, because you don't even have to put money in and they give you 4 free stocks. But more importantly, the big bottom line is you got to track the velocity of money. Like literally write this down, track velocity of money and put it up on your wall. And just all you have to do is go divide GDP by monetary base. There you go. Now you can track the velocity of money. Or alternatively, if you want an easier way to track that, just subscribe to Meet Kevin and share his videos. Now, only if you appreciate the videos, of course, would I ask you to share them. When it comes to this inflation debate of there has to be inflation or no, there's not any inflation, we don't see it now, let's just keep printing money. I'm not trying to take sides. As usual, I just want to report to you that in order for us to see inflation, we have to see the velocity of money move. Until we do, we probably won't see inflation. But when those metrics start moving, if our GDP overheats and the monetary base, and we see the ratio between those two explode, that's when we want to be a little bit more concerned. That's when we want to start paying attention and go, oh damn, okay. Because once that starts happening, then the Fed's probably going to be more likely to start reducing their bond purchases, which would, we're waiting for their comments obviously this week on that. Then we're going to see interest rates go up. Then we're going to start trying to see this combating against an overheating of the economy because inflation is coming. So hopefully this helps you understand this. I know it's a complicated subject, but I think, I don't know, let me know in the comments, but I think many of you prefer these sort of more detailed analysis videos. I really love this kind of stuff. But, don't, oh, that's not the don't, I thought this was the don't sue me bro mug. This is, some people think this is like a not good symbol because it's like a triangle hat. This is the gnome child in the, in RuneScape. Yeah, you could Google that. He's a meme. He's kind of like Bernie. Oh, we should put Bernie on a mug like that. But yeah, if you just Google gnome child, you will see. See, look, gnome child. Yeah, I don't know. Don't ask me why. It's a triangle hat, but it is. Gnome children are like young gnomes found in the tree gnome stronghold. Like adult gnomes, they can be killed or pickpocketed. That sounds horrible. Okay, folks, thank you so very much for watching this video, and we will see you in the next one. Get your Robinhood stuff right now. Doesn't cost you anything. Go do it.